Alright guys, so I'm going to go over the portfolio just to give you an idea of my thoughts on it. And no, I'm not a trader, but the funny thing is I am actually reading a book. Oh, hang on a minute. Knock some off the wall there. Let me just get the book that I'm reading so I can give you its name. It's called Rule Breaker Investing by David Gardner. If you know the Motley Fool, then you probably know who David Gardner is. If you don't, then I do recommend having a look at that. Some of the logic that he's got in here actually mirrors what I do. And the weird thing is, I bought all the investments before I even read the book. The logic is similar, I think. I'm still halfway through the book, so I may be completely wrong. It may completely change before I get to the end of the book. But I'll just go through what my investments are and why. So down here, this is basically what's most owned. This isn't my portfolio. This is who owns most stocks, etc. So we'll come back to that later because I'll probably do a little bit of an intro video. So let's click on my portfolio. And this one's inside 212. As you can see, we've had a bit of a downturn. Not particularly bothered. The reason being is investments, you should, funny enough, you said this in the book, minimum should be 3 years, because there's a 3-year cycle that is seen in investments, in stocks and shares stuff. So your minimum should be 3 years investments. The reason being is you normally have 2 good years, 1 bad year. So let's face it, if you had 2 good years, then a bad year, then I would recommend staying for the next year because it's likely to go up. Just by design, I think. So this is basically what my investments are at the minute, and then I'll go into them in more detail. So this is the FTSE North American for Vanguard. As you can see, it's gone up, it's had a bit of a dip, but if we have a look at its pattern, it's generally on and up, and the market itself generally grows by about 10% on average per year. This is the whole point of the cycles, but it doesn't mean that you can't suddenly have some jumps. But the first thing I've done here is recognise I want some stability. So I've started with Vanguard funds, which are managed by others, and each one of these funds is invested in a lot of different companies. So if you look here, the emerging markets ETF has traded with a tight range, but that's a bit of a description. But they're actually invested in multiple companies. So just bear that in mind. When you're buying these funds, it's the equivalent of, say, investing in 100 companies or 500 companies. But you don't need to have a share in every single one. You just put the money into the fund. So I'll keep it simple at the beginning. So these all have different functions. As you can see here, Asia Pacific's growing. Is it down this week? Let's have a quick look. Yeah, see a slight dip there. But even if it went back down here, I'm expecting growth because on average, growth occurs unless something really bad happens. So that's my Vanguard funds, and I've got, as you probably noticed, all these are like Asia Pacific, global aggregate bonds, etc. They're not in the S&P 500 because I've got the S&P 500 with a lot more money on it on my actual Vanguard account on Vanguard. Now, if we start looking at some of these other ones, this is Realty Income, which is obviously, as it says on the tin, as you can see, it's a bit volatile. It's on its way down, on the way up. It's moving. I think that's been down consistently, but look for a month. Oh no, it has gone up. Oh, it was dropping significantly. It does look like it's had a bit of a recovery there. But with this one of the reasons people invest in this one is this: the dividends, 5.35%. Is this return on investment? This is why a lot of these are different pies, but we'll get into those later. You can see this here is telling you what their return on investment with that high was last year. See 8.73, 10.94, 6.7, 12.69, 5.66, 13.09. Now, ideally, what you're looking for is that 5% on your dividends plus growth, because that will give you 10% plus. Now, these initial investments are the reoccurring ones. These are the ones that are basically invested in because they do have some dividends and they do have some slight growth. So, like Legal & General is another one I've started investing in. As you can see, it's dropped a lot, but if we have a look on average, moves up and down a bit, but it's not too bad because I'm after the dividends on this one. I've lost 85 pence. I'm not particularly bothered on that. It's got a dividends of 9.13%. Is something that's a long hold. So Legal & General is one of those ones I'll sit on and just keep. A lot of these are ones I won't sell off. The only reason I'd look at Legal & General and Phoenix as a sell-off, because Phoenix is very similar as well. There's another one I've got invested in. You see Phoenix is not doing well. It's had some changes in the business itself. Not particularly bothered. It's another one that has a high dividends. That was at 10%. It's dropped 8.42 at the minute. Reality is these have paid consistently dividends. These two companies are predominantly in things like pensions and bonds. And one of the problems we've got at the moment is the UK has moved its bonds, its gilt, from RPIX, which is the indexation, which was sort of aligned with inflation, and so that it was actually doing better than the way they've gone now. Because if you have a look at RPI and you look at how it functions, it affects rail prices, all that sort of stuff, and they decided to do something different so that the current government basically have changed the indexation, so it's growing it between 0. They basically, as an investor, where you bear in mind these companies invested in it, the growth has changed the dynamic by 0.08 and 1% per year, which is significant. It's a lot of money. When you bear in mind pensions and stakeholder investors are just in my mind being robbed by the state. But anyway, that's how they changed the index system. In 2030 is going to see some more changes. So these funds I'm looking at as up to probably 2029, then I may take that money out because I think the market may shift. But I'm not in a rush because A, the dividends will keep coming out, and B, the government's likely to change by then, so there'll be some differences. Microsoft, everybody knows why people invest in Microsoft. It has significant growth. If we take this to the max, it's on a constant climb. So these are the stocks that will find a new way of generating new revenue in theory, with a great new idea somewhere. So the dividends on these isn't that great. See, 0.65, but the growth on it is significant. It jumps. It's a good investment. So we come out of Microsoft. Kimberly Clark, it's had a bit of a rough ride lately. I think they're going through a restructure, as you can see. But look how bad it's been since 2019. It's always been up and down. So I'm not particularly bothered about this one. This is one I'm going to keep holding. Dividends 4.12. As you can see, it's in a dip at the minute, and I bought this in a dip, so if it does jump, it'll be good. IBM, another one that's worth the investment because, well, there you can see from the chart itself. But we have a look in the last week. It's been it looks like it's on a downward, but things change overnight. Dividends wise, 2.38%. Alphabet, you recognise the logo there. You can see that one has a fair bit of movement. That's in a week. You can see that's looking very healthy. May get correction on it. Low dividends but high growth. Procter and Gamble, stable one. It obviously goes up and down like everything else, but I'm buying into these for the long term. See 2.73. It's on a little bit of a downward trend, but that corrects itself over in no time. Apple's another one that jumps, and they do buybacks as well. So you can see significant growth on there. And the dividends won't be great, 0.4. Tesla. I'm expecting Tesla to have some movement in it, and I'll give you a couple of things that I'm looking at. With Tesla, they've got the robot stuff that they're working on, but also they're starting to get to a position for these sustainable housing. So I think there's an opportunity that some of that's going to jump. So I do think there's an opportunity for growth in that. That's my personal opinion. I'm not your investment guide or whatever. Palantir is to do with the data. I think that's in a market that's got a lot of growth available in it. Pfizer, I think I mentioned this the other week because I think they've got a anti-cancer drug that's coming through, so I can see that one going on a spike. Because don't get me wrong, we all know why Pfizer jumped, but after COVID, after Viagra, it's sort of not really seen much growth. But the way I look at it, they've got a hell of a lot of money, which means they've got a hell of a lot of stuff in the pipeline. So the opportunity for that to suddenly spike, I would say, is definitely there. 6.98 dividends as well, so it's worth keeping money in it as well. Lloyd's was one of the ones I got free. Moderna, another one that I got free. But there's another one that I do suspect is going to have similar effects with something it pushes out in the market. See, this is done well out the COVID stuff, but you've got to bear in mind there's got to be some push on this. They've got to have some stuff in the pipeline. So this is why I'm saying keep an eye on some of these and do your own research. The American market's had some changes recently. We've got the impact of tariffs with China, but if we look at Eli Lilly, which I haven't bought yet, that's probably on a down. Eli Lilly. There, look. When was that? That's in a week. Yeah. So Eli Lilly, I think this has been caused by. Don't correct me if I'm wrong. With the US now starting to try and push the cost of medication down. Now, I look at it logically that if 1,000 people were buying expensive medicine and 10,000 people buy cheap medicine, I'm expecting Eli Lilly to go back up. I think they'll have to just adapt to their business model. So Eli Lilly, for me, has got two key things. A, the weight loss drugs, and B, it does a lot of stuff like insulin. So there is significant growth opportunity in there, in my opinion. Do you notice how I started off the recording saying keep your investments for more than 3 years? This is exactly why, because we don't know when that peak's going to happen, but you can see generally it'll go up. So I do recommend getting into Eli Lilly. At the moment, I've run out this month. I've had to slap myself on the wrist because I keep putting money into investments. But Eli Lilly is one I want to invest in. What else have we got? Let me go back to why I've done it the way I've done it. That will make sense. Go back. So like there, you got break it out on dividends. So you can have a look through and see who's doing well on the dividends. I'm a bit wary on putting too much in real estate at the minute because I think we could have some market shifts with immigration changes. So I'm a bit wary on that at the minute. So same with vehicles. There's a lot of negative debt because of things like car finance for people that were illegals that are no longer in the US and probably going to end up the same in the UK and elsewhere because it's going to create a problem with the car loans, which could be worth a fortune. So Aviva's another one. So it looks like it's peaking out, but I don't think it is. 6.31%. Now the reason I keep mentioning these dividend amounts as well is just look at what you get on your bank if you stick things in your investment funds for your 2% or whatever. You may be better off taking more risks on some decent stocks. And I'm not telling you what a decent stock is, that's up to you. But now I'll go back. I've lost where I was. Oh. Okay, back to where I was. Because I want to talk about why I've done it this way. So with my own investments, I work on two things: risk and a constant income. So I want growth on it constantly. So when I say income, it's actually to increase by at least 10% a year with a bit of luck. So this is why I'm heavy on the Vanguard funds, because I'm going to use them to offset stupid investments as well as ones that suddenly jump. So that's why you see a lot of these are smaller than can we go back to where's my actual breakdown? It's alright, there's pie charts. Where's the pie charts? Ah, here we go, the pie charts. Right, so in here you'll notice some of these I've directly invested in because I want a little bit more flexibility than I've got in the pie charts. And like this one I wanted to buy, this one I wanted to buy, this one I actually bought wrong because it's actually in the pie, but I'm not too worried on that. I'll leave that one. Pfizer I want to increase. This one was a freebie. This one was a freebie. Microsoft I want to increase. Kimberly-Clark I want to increase. This one is sat here waiting for me to decide whether I put money in it or not. This is a copy of somebody else's dividends. Should we have a look? Yeah, let's have a look. So at the moment it's got no money in it, but what it is, this is a pie chart with the holdings already broke down. So what I've got here, got Tesco, Sainsbury's, British Foods, Unilever, Legal & General, M&G, Aviva, Centrica, ITV, Phoenix, National Grid, Vodafone, Diageo. What's Diageo do? Always scroll at the bottom, by the way, because it tells you a bit about them. Produces, markets and sells alcoholic beverages. The company offers scotch, whiskey, vodka, blah blah blah. Okay, so that gives you a basic overview if you're wondering what they were doing. Oh, and we forgot to flick down the bottom there. What's the dividends yield? 4.29%. So I copied someone else's, which I haven't put any money in because I've just seen it would look quite useful because it's got a lot of the people I want in there. But before I actually use this, I'm going to add the other supermarkets as well, because I think there's plenty of growth in the supermarket industry with the fact that we've got the immigration problem in Europe at the minute because we've got too many people in, which means the growth is going to be in these sectors. But the idea being this, we got his original pie. I think we should actually show his pie because this is, so that's his growth, 15.24, and that's his breakdown. So put 24% in Tesco's, 14% Sainsbury's, 9% in Unilever, and that's his breakdown on there. But this is the sort of thing you look for, is the yields for the returns on the investments. And as long as I'm getting above 10%, that's what I'm looking for. So if I've got something that's working, don't get me wrong, that's last year's, but I would suspect the same is going to happen this year. So this, for me, seems like a decent pie. Maybe completely wrong, but I'm just talking from the way I think. Now we look at the ones I've done myself. This one's obviously losing money at the minute, allegedly. I say allegedly because that's not any dividends yet. So in my pie, it's got IBM, Microsoft, the Googles, the Apple, BlackRock, BP, Coca-Cola, Johnson & Johnson, Kimberly-Clark, Palantir, Procter & Gamble, Real Estate, Realty Income, Rolls-Royce, and Tesla. Rolls-Royce is a bit of a wild one. As you can see, it's got a bit of a peak on there, but I'm going to keep some money in it because, quite simply, I can see an opportunity because it's Rolls-Royce. It does get some jumps in there, so I'm going to keep that one in as an opportunity. We'll see where it goes. Because there does seem to be an issue with engines at the moment, by the way, aviation engines. So there may be something that spikes on there. So that's what this one's a dividends setup. So this is why I'm not particularly bothered about this bit, because it's all the little dividends that come in over time. Because I don't think I've had anything off Realty as well, because that was down. See, that's had a little bit of movement. So you see 5.35. High Dividends Company. What's this one? I'm going to open that in a. I want to open that in a different window. 8.74. So you've got two Vanguards and the Realtor. Okay. Right, anyway, I'm getting sidetracked, guys, so I'm going to move back. This one over here is performing a bit better, but this is. See, I bought these by mistake before I used the system, because these are actually in here, but I bought them separately thinking I was actually expanding it because I didn't know how the pie system worked at the time. So I'm not going to knock it, I'll just leave these here. So I've got a lot more in the Vanguards than it appears. I don't know if I can drag that over. Can we try? No, it won't let me. So ideally I want all those in the pie. But that one there is a different spread of the different Vanguard funds. Where is it? Double click. Where are you? Our holdings. Yeah. So you can see I've got a spread in there, but ideally I want that in there, because then it just reinvests across the board. But if you know who get that in there, I'd appreciate it, because I'd like to tidy this side bit up. But the idea being is these funds, I think, are fairly stable. There's growth in them. I'm not particularly bothered. And the way I'm investing, let me get to the main point. I know some of you guys are going, oh, just get to the bloody point now. I've set it up so I have two sets of things going on here. These guys are reinvesting in doing their bit for me. My picks is dividends. And what I want down here is I'll start building these up with the ones that I see as opportunities to go to the moon. So at the moment it's a little bit messy because, like I said, I didn't know how to use the software properly. I mean, I got the investments right, it's just that all these Vanguard ones should actually be in motorbike. Why motorbike? Well, the motorbike is going to cost me about £6,000. So I'm putting about £6,000 in here, and letting it roll and see how we get on. So hopefully we end up with a motorbike for free. My picks, it's just going to roll with dividends, but this will start leveling up anyway. So this one is currently set that I'm putting £150 a month into this one, so this one's going to catch up with that quite quick. So this one is going to be sort of almost daily payments through these, where this one is a little bit slower, which is why it sort of shows losses, because it depends when the dividends come out, because a lot of them don't jump that well. I mean, Apple will jump at some point, but I'm not sure what they've got to jump with at the minute. I don't know what's new with those guys, but I've picked them because they do dip and then jump, dip and jump, dip and jump. But I'll leave that for that. I just want to give you a quick overview of where I am. If you're British, this is sitting inside an ISA. So as you can see, a 212 stocks ISA, which is an individual savings account. That's tax free. So this is what I've put in, and that's what I've got left. I've lost a little bit of money, but I've not really lost it at all. Come Monday, I'll find on a Friday it dips anyway. Monday it goes back up again, so that'll probably be 673, 74 come Monday afternoon. So I'm not particularly bothered about that. But the idea being that 150 goes into, well, I'm all over the place again, goes into this one a month, and then I'll be up in this one, because these two I want to hit 1,000 each. I'm thinking of putting this one up to 1,000, and once I hit that, that's when I'll start going to the moon type stuff, where suddenly I'll start picking and putting, say, a couple of £100 in each riskier investment and seeing where we go with it. Because you've got to bear in mind, I want a bit of stability. So these guys, the profits of these guys will fund things that go haywire or become complete losses. so that the portfolio still increases even when we make some bad mistakes, because you don't need to be right all the time, you just got to be right some of the time. Because if you get a moonshot where something goes from like here to here, what was that originally? What's the price on that? So like there, it was $28 to $245, and that's not impossible, but you've just got to know what you're looking at. You've got to understand what the stocks now are. These are, for me, just steady eddies, because I think the dividends on these have paid out consistently for about a decade. This one is consistent, but I'm starting to see this as a risk because the market's changing. Lloyd's been around forever, so it's not going to be inspiring, but it's worth just having some cash in there for a drip feed. Kimberly Clark, I do think it's going to have a jump in it at some point. It may still be on a downward trend. I want to get this from 26 to say 200. So when it jumps, it jumps. But the other thing is, I'm not going to dump it. When that jumps, I just want to be a buy in at 26 that goes to 200, and then I just want the dividends. I just want these buy-ins where these things recover. I like to buy in a dip, but I don't not want to sell. It's the difference between investing and speculating, and overall how we're doing in our first month. Bear in mind, some of these are investments. So if we look at where we are today, we're still up by £20.91, 4.9% return in a month. And it's not even a full month. When did we first invest? Has it got a date? 18th of September. What's today's date? 18th of October. So that was actually a good time, wasn't it? I didn't even know that was. I've been doing it that long. But that's 4.9% return in a month. But anyway, guys, love to hear your thoughts, and I do want to talk about more stocks and shares. I do want us to talk about hot picks. But I've run out of money till payday, so what's in's in. Because one of the things I will say, I won't be doing pumping and dumping. I'm not into that. I'm looking at stuff that's steady Eddie. I want stuff that I know has growth markets in it. And I know some of these companies may be ethically challenged, but quite simply, I'm not even going to get into that because there's all sorts of stuff we could get into. But I'm happy with what my portfolio is looking at the moment. Love your feedback. I know some of you guys are going to go, well, why are you still using Vanguard when you should be trading yourself? I agree with you. But I wanted a bit of stability while I learned how to use the software. We've nearly got our first 1,000 in here, which come payday, that'll be up to over £800 anyway, which I don't think is bad for the first month. You know, going into the second month, we're nearly 800 quid in it. I think we're doing well. Anyway, guys, thanks for watching.